What if the most powerful financial instrument in history wasn't a stock, a bond, or a digital currency, but a single line of text signed a century ago that never asks for its principal back? We live in a world of 30-year mortgages and quarterly earnings reports, a frantic sprint of short-term debt. Yet, beneath the asphalt of our global economy, buried in the vaults of central banks and sovereign funds, lies a slower, colder, and far more enduring truth: the perpetual debt. This is not a story of a loan that was repaid. This is the story of the 100-year loan, the hidden interest rates that quietly, inexorably, still fund modern empires. The cognitive dissonance is staggering. We champion fiscal responsibility while our entire system rests on debts designed to outlive us all. Who are the creditors? What did they buy? And what is the ultimate price of money that never comes due? The genesis of this financial forever war did not begin on Wall Street, but in the smoldering aftermath of the Great War. Europe was physically and fiscally bankrupt. Governments, drowning in short-term war bonds coming due, faced a simple, terrifying equation: instant austerity and collapse, or financial innovation of Faustian proportions. Enter the consolidate, short for consolidated loan. It was Britain's desperate, genius solution. The promise was seductively simple: lend us your money, and we will pay you interest. Forever. The principle? Never. It was a financial particle accelerator, turning the immense weight of national debt into a perpetual, manageable stream of coupon payments. For a shell-shocked world craving stability, it was the ultimate safe asset. But this safety was an illusion built on a monumental gamble: the bet that the British Empire itself would exist in perpetuity. The Consol was more than a bond. It was a silent covenant between the state and capital, rewriting the social contract. It created a new, immortal class of creditor: pension funds, university endowments, and the dynastic wealthy, whose prosperity became permanently glued to the state's survival. The government gained breathing room, but at the cost of pledging a slice of its future tax revenue, forever, to a private audience. This was the birth of the modern rentier state in its purest form. The money raised didn't build factories or roads in the traditional sense. It serviced the past. It was a fiscal time machine, using future generations' labor to pay for yesterday's cataclysm. The loan became a ghost in the national machine, an eternal, whispering claimant on the treasury. From London, the virus of perpetual debt spread with imperial ambition. Other wounded empires, seeing Britain's sleight of hand, adopted their own versions. France, Belgium, and later, emerging economic powers, all issued instruments that promised eternity. The architecture of 20th century global finance was being built on a foundation of infinite duration. This created a hidden lattice of intergenerational obligation, a financial substrate that allowed nations to project power, building navies, funding colonies, fighting new wars, without ever truly settling the bill. The hidden interest rates were the engine of empire, a slow-drip transfusion of capital that turned sovereign debt from a temporary burden into a permanent feature of the geopolitical landscape. But eternity is a long time to bet on an empire. The first great crack appeared not with a bang, but with a whisper of inflation. A perpetual bond promising 2.5% is a marvel in a stable world. But what happens when prices begin to creep, then run? The real value of those fixed coupon payments, the actual meat and bread they can buy, evaporates. The creditor slowly bleeds out. The post-war inflation of the mid-20th century was the first silent default on the promise of forever. It was a warning, ignored by most, that no financial instrument is truly timeless. It merely transfers risk in ways unseen. As the chapter closes, the console, that immortal edifice, still exists on ledgers. But its power has waned, its lesson unlearned. For the game was not over. It had simply moved, morphing into new, more complex forms of everlasting debt that would fund the next century's empires. The old perpetual bonds faded, crippled by inflation. Yet, from their ashes in the 1990s, a new, more sophisticated species of century-long debt rose. Why would any investor, scarred by history, again lock money away for 100 years? The answer lies not in greed, but in a terrifying mismatch of timescales that haunts our entire financial system. The new architects were not nations, but corporations and quasi-sovereign entities like the World Bank. The driver was a demographic and actuarial time bomb: pension funds. These mammoth pools of capital have liabilities, pension payments to retirees, that stretch out for decades, even a century. They are legally required to match these future payouts with stable, long-dated assets. The problem? The market was saturated with 10 and 30-year bonds. Enter the 100-year corporate bond. For a pension fund, it was the holy grail, an asset whose cash flows perfectly aligned with their distant obligations. For the issuer, it was a gamble on immortality, betting the company would outlive its founders, its industry, and its original business model. The first major salvo was fired by Walt Disney Company in 1993. They issued $300 million in 100-year bonds at a 7.55% yield. The pitch was a narrative as powerful as any film. Bet on the endless childhood, on stories that never grow old. Coca-Cola, IBM, and others followed, leveraging their brand's perceived permanence. This was debt as brand equity, a vote of confidence in corporate eternity. The money raised was often used not for epic capital projects, but for share buybacks and acquisitions, using the certainty of the distant future to juice present-day stock prices. The long-term loan was fueling short-term markets. The real turning point, however, came from an unlikely source: Austria. In 2017, in a world of near-zero interest rates, the Austrian government issued a 100-year bond. The yield? A mere 2.1%. Investors fought to buy it. This was the paradox in its purest form. Lenders were so desperate for safe, long-term returns they were willing to accept microscopic payments for a century. They were betting that the alternative, cash or shorter bonds, would yield even less over time. This was the hidden interest rate at its most potent. A rate so low it was essentially a subsidy to the sovereign issuer, a signal that the market had more faith in Austria's survival for 100 years than in the value of money itself. This global hunt for duration created a bizarre inversion. The poorest, most financially unstable nations could not issue such debt. They lacked the perceived immortality. The privilege of borrowing forever was reserved for the established and the robust. Thus, the 100-year bond became a tool of divergence, not convergence. It allowed rich nations and blue-chip corporations to lock in cheap financing for generations, widening the moat between them and the rest. The financial empires of the 21st century were being fortified not with gold, but with the unwavering faith of pension funds betting on a future that might not belong to the people whose money they managed. The stage was now set for the ultimate expression of this faith: debt that lasts not a century, but literally forever. If a 100-year loan is a bet on a century, what do you call a loan with no maturity date at all? The perpetual instrument had returned, not as a relic, but as the engine of a new kind of economic empire. At the heart of this system is the central bank's own version of a perpetual bond, the currency itself. A dollar bill is, in essence, a zero-coupon perpetual bond issued by the Federal Reserve. It never matures. Its interest rate is the erosion of its purchasing power through inflation, a negative yield the holder is forced to accept. By managing the supply of this perpetual debt, central banks control the price of all other debt, including our century-long loans. This is the ultimate hidden interest rate, the right to print the perpetuity that underpins everything else. This power found its most aggressive modern application in China's economic miracle. Key to funding its unprecedented infrastructure and state-owned enterprises, SOEs, were perpetual bonds issued by policy banks and local government financing vehicles. These were not bonds in a traditional sense, but equity-like instruments that could, in theory, exist forever, paying interest but never requiring principal repayment. They provided a massive, flexible, and off-balance sheet pool of capital. The hidden interest rate here was political, not market-based, the implicit guarantee of the Chinese state, which ensured these instruments would never be allowed to fail. The capital raised by these perpetual engines built the physical empire of the 21st century. High-speed rail networks spanning continents, ports from Greece to Pakistan, cities rising from empty land. It was a sovereign-level application of the Disney logic, but with steel and concrete. The bet was on the perpetual growth and stability of the party itself. For global investors hungry for yield, these instruments offered a tantalizing premium, backed by the world's second-largest economy. They were buying a piece of China's forever story, financing its geopolitical reach with money that never demanded to be paid back. But perpetual debt, by its nature, must be serviced forever. The coupon payments on China's vast hidden liabilities create a constant, massive drain on fiscal resources, demanding relentless economic growth to feed the beast. It creates a treadmill from which there is no orderly exit. This model exports a powerful, seductive, and dangerous template to the developing world. Growth today, funded by obligations for all tomorrows. It raises the provocative question: is this the ultimate financial innovation, or a pyramid scheme scaled to the level of civilization? As we delve deeper, we must confront the sinister twin of this perpetual funding machine. Who holds the other end of these eternal contracts, and what power do they wield? For every perpetual debtor, there is an eternal creditor. These are not individuals, but vast, patient, and often opaque pools of capital, sovereign wealth funds, foreign exchange reserves, and the ultimate buyers of last resort. Their identity reveals the true geopolitical landscape shaped by hidden interest rates, a world where finance is the primary theater of war. The largest single holder of U.S. Treasury debt, the closest thing to a global perpetual bond, is not a hedge fund, but the U.S. Federal Reserve and other U.S. government accounts. The second largest is Japan. The third is China. This triad forms a tautological loop of mutual dependency. America issues perpetually rolling debt to fund its deficits. Japan and China, flush with trade surplus dollars, recycle them back into treasuries to stabilize their own currencies and ensure their export economies keep running. The hidden interest rate. Here is the geopolitical stability premium. China accepts a lower financial return on its trillions in U.S. debt in exchange for access to the largest consumer market and a, relatively, stable global system. Sovereign wealth funds, SWFs, like those of Norway or the Gulf states, are the epitome of the eternal creditor. Built on oil revenues, a finite resource, their mandate is to convert transient wealth into a perpetual endowment for future generations. They are explicitly designed to outlive the oil, to be forever. To achieve this, they are among the most aggressive seekers of long-duration and equity-like assets, including infrastructure, real estate, and yes, century bonds. They are not just investing. They are quietly purchasing strategic slices of the global commons, ports, power grids, tech firms, with a time horizon measured in centuries. Their hidden interest rate is the dividend of sovereignty and intergenerational security. This creates a new form of quiet imperialism. When a nation's pension fund or SWF owns the toll road, the water utility, or the digital infrastructure of another country, it extracts a perpetual, low-risk cash flow. The relationship is not colonial in the 19th century sense, but it is powerfully extractive. The debtor nation trades a piece of its future economic sovereignty for capital today. The creditor empire grows not by planting flags, but by accumulating digital entries in a securities depository, securing a claim on foreign cash flows that can last longer than any political dynasty. The ultimate power of the eternal creditor, however, is the power to walk away. The threat is not of calling in the loan, which is often impossible, but of slowing or stopping the rolling over of debt. This is the nuclear option of finance. When China slows its purchases of U.S. treasuries, or when a SWF reallocates away from a country's bonds, it sends seismic shocks through the system. It forces interest rates, the price of perpetuity, to rise. This is the lever. The hidden interest rate is, therefore, a barometer of geopolitical trust. When that trust erodes, the rates hidden in plain sight can rise violently, revealing the fragile fiction upon which modern empires are financed. This sets the stage for the system's most vulnerable point, the moment the music of perpetual rollovers threatens to stop. The dirty secret of perpetual finance is that nothing is truly perpetual. Maturity dates can be erased, but the need to constantly find new lenders to pay off the old ones cannot. This is the rollover, the system's addictive heartbeat. And when the rollover falters, the hidden interest rates become brutally visible. Imagine a government or corporation with $1 billion in debt coming due. In a healthy market, It simply issues new debt to new investors, uses the cash to pay off the maturing bond, and continues. This works as long as faith holds. But what if investors doubt the borrower's future? They demand a higher interest rate for the new debt. This instantly increases the cost of servicing all existing debt. For an entity laden with perpetual or long-term liabilities, a spike in its credit spread is a death spiral. It must pay more to keep the game going, which weakens it further, which forces rates even higher. This is the rollover trap, and it is the fundamental fragility hidden beneath the calm surface of century-long loans. We have seen this movie before in miniature. The European debt crisis of 2010 to 2012 was a rollover crisis. Countries like Greece and Italy didn't necessarily need to pay back all their principal at once. They just needed to constantly refinance it. When market faith evaporated, the interest rates demanded to roll over their debt became unsustainably high, threatening sovereign insolvency. The perpetual nature of their debt stock became a curse. As the rising cost to service, it consumed an ever larger share of the national budget. The hidden interest rate was no longer hidden, it was a screaming headline. Today, the rollover risk is systemic and magnified by quantitative tightening, QT. For over a decade, the Federal Reserve and other central banks were the ultimate, patient buyers of government debt, suppressing interest rates through sheer purchasing power. This made the rollover effortless, cheap, and invisible. Now, as they reduce their holdings, that colossal, reliable buyer is stepping back. The market must absorb trillions in new and rolling debt without that backstop. Who will buy it, and at what price? This is the great unanswered question hanging over the system of perpetual finance. The hidden interest rate for the next century is being set right now in this tug-of-war. The trap is baited by the very structure of the loans we've explored. A corporation that locked in 2% for 100 years in 2020 looks brilliant. But if market rates soar to 5% for the next decade, the opportunity cost for the investors who bought that bond is massive. They are trapped in a losing asset. This creates selling pressure and illiquidity, making it harder for the next entity to issue its own century bond. The system seizes up. Thus, the rollover trap is not just about new issuance. It's about the marketability of the old, perpetual debt. When the music slows, everyone looks for a chair, but the bonds have durations longer than a human life. There are no chairs, only a standing obligation that must be passed, like a hot stone, to the next generation of believers. This leads us to the ultimate inheritors of this burden, us. All debt is a claim on future output, but perpetual and century-long debt make this claim explicit and eternal. This raises a profound ethical and economic question. By what right does one generation mortgage the future labor of generations yet unborn, without their consent? This is the heart of the hidden interest rate. It is the interest paid by our grandchildren. The mechanism of the theft is subtle. When a government issues a 100-year bond to fund current consumption or tax cuts, it allocates a portion of future tax revenue to today's bondholders. Those future taxpayers, our children and grandchildren, will have to work to fund those coupon payments, receiving no goods or services in return from the original borrowing. Their standard of living is effectively lowered to subsidize the past. It is a slow-motion transfer of wealth across time, facilitated by a financial instrument that outlives its creators. This is exacerbated by demographic decline. An aging population means fewer future workers to shoulder the burden of a growing stock of perpetual liabilities. Japan is the canonical example, a shrinking, aging populace servicing the largest public debt stock in the world, much of it held domestically. The hidden interest rate here manifests not as inflation, which has been absent, but as decades of stagnating wages, suppressed consumption, and a constant drag on fiscal policy. The future was borrowed, and now the bill, in the form of foregone prosperity, is coming due. Proponents argue this isn't theft but intertemporal smoothing, using capital markets to spread the cost of large projects, like winning a world war or building a green grid, over the generations who benefit. There is truth here, but the ethical line is crossed when the debt funds current consumption with no lasting asset, or when the terms are so long that the link between benefit and cost is broken. A century bond issued to fund a politician's popular but unfunded program is fundamentally different from one issued to build a dam that will operate for 200 years. Too much of our perpetual finance falls into the former category. The most pernicious effect is on political accountability. Politicians face short-term election cycles. Perpetual debt is the ultimate tool for kicking the can down the road, creating massive, off-balance sheet liabilities for the future. It allows for painless spending today, with the pain deferred beyond the political and even biological lifespan of the decision-makers. This creates a profound democratic deficit. The hidden interest rate, therefore, is also a rate on our collective morality, the interest we pay for choosing present comfort over future justice. As we grapple with this legacy, we must ask, is there an escape, or are we forever bound to the stone? For the perpetual debtor, there is one historically proven, brutal exit strategy: inflate the debt away. If you owe $1 trillion and can devalue your currency so that $1 trillion is worth a loaf of bread, you've effectively defaulted without formally defaulting. This is the ultimate wild card in the century-long debt game, and it is why the hidden interest rate is always, secretly, a bet on the future value of money itself. Inflation is the creditor's nemesis and the debtor's sly savior. Recall the British consols. Issued with fixed coupons, their real value was devastated by the inflation of the 20th century. The British government honored its literal promise. It kept paying the 2.5%, but in pounds that were worth a fraction of their original value. This was a stealth transfer of wealth from bondholders, savers, to the government, debtor. It is the most common form of sovereign restructuring for perpetual debt. The hidden interest rate becomes negative in real terms, silently erasing the obligation. This reality casts a long shadow over today's low-yield century bonds. An investor who bought a 100-year Austrian bond at 2.1% is making a colossal bet that inflation in the Eurozone will average less than 2.1% for the next century. A single decade of sustained 4% inflation would catastrophically impair the real return. Debtors, aware of this, may have a perverse incentive to tolerate higher inflation. It softens the real burden of all fixed-rate debt, providing a pressure release valve for over-indebted systems. The eternal war between creditor and debtor is often fought on the battlefield of monetary policy. This creates a dangerous feedback loop. If markets begin to suspect a major debtor will resort to inflation to manage its perpetual liabilities, they will demand higher interest rates on new debt to compensate for that risk. This makes the debt burden heavier in the short term, potentially forcing the debtor toward the very inflationary policies they feared. It's a self-fulfilling prophecy. The perception of the inflation escape hatch can itself trigger the crisis it is meant to avert. We now stand at this precise precipice. After decades of low inflation, the post-pandemic surge was a wake-up call. It demonstrated that the dragon is not dead. For the holders of trillions in long-duration fixed-rate debt, pension funds, insurance companies, sovereign wealth funds, it was a moment of sheer panic. It revealed their vulnerability. The hidden interest rate they thought they had locked in was, in real terms, vaporizing before their eyes. The search is now on for a new kind of perpetual instrument, one that can survive in a world where the value of money is no longer a constant. This search is leading finance into the realm of myth and pure narrative. When the mathematics of perpetuity break down, when inflation threatens, when trust in institutions wavers, what is left to back a 100-year promise? Only a story. The final, and perhaps most potent, evolution of the hidden interest rate is the narrative premium, the extra value the market assigns to debts backed by a compelling, eternal-seeming mythos. Disney's 100-year bond was a pure narrative asset. Investors weren't buying cash flows from theme parks in 2093. They were buying the myth of everlasting magic, the belief that Disney's stories would forever captivate humanity. Similarly, a century bond from the Vatican or a university like Oxford or Harvard carries a narrative premium based on spiritual authority or intellectual permanence that transcends economics. The hidden interest rate here is incredibly low because the risk of the story ending feels remote. The debt is backed by faith in an idea. In the 21st century, this narrative power has been hijacked by technology and ideology. Green bonds, or perpetual sustainability bonds, issued to fight climate change carry a narrative of saving the planet. Investors accept lower yields because the investment aligns with a values-based story about the future. The hidden interest rate incorporates an ethical discount. Conversely, Debt issued by a regime with a powerful nationalist ideology, e.g., certain perpetual instruments in the Gulf, is backed by the story of enduring dynastic and cultural power. The narrative becomes collateral. This is precarious. Narratives can change faster than balance sheets. A corporate scandal, a technological disruption, a geopolitical realignment, or a simple shift in cultural values can shatter a narrative overnight. When the story cracks, the narrative premium evaporates, and the hidden interest rate, the true, hard financial cost of the debt, spikes violently. The asset transforms from a perpetual dream into a toxic, unsellable liability. The 2022 meltdown in mission-driven tech stocks was a preview of this. Stories of changing the world collapsed under the weight of interest rates, revealing the naked financial engineering beneath. We are left, then, in a surreal financial landscape. The most enduring debts are no longer backed solely by cash flows or assets, but by the most fragile thing of all, a collective belief in a story about the future. The American Treasury debt is backed by the story of American exceptionalism and the dollar's reserve status. The European project's debts are backed by the story of everlasting peace and integration. The hidden interest rate is the market's minute-by-minute assessment of the credibility of these grand narratives. When those stories fray, the entire edifice of perpetual finance trembles. This brings us to the inevitable question looming over our century. What happens when the story ends? No empire lasts forever. No currency holds its supremacy for a millennium. No corporate brand is immune to oblivion. The foundational assumption of perpetual debt, that the issuer will exist in a recognizable form for the duration, is a statistical fantasy. We are not asking if the breaking point will come, but when and how. History offers a library of endings. The most common is not a dramatic default, but a slow fade via financial repression and inflation, as we've seen. Another is consolidation. A new, stronger entity assumes the old perpetual debts. This happened as the Kingdom of Great Britain absorbed older English debts. The European Union's various stability mechanisms are a modern attempt to socialize and mutualize the perpetual liabilities of member states, creating a larger, more credible, forever issuer. The breaking point is avoided by expanding the circle of perpetuity. A more violent end is explicit restructuring or default. This is rare for sovereigns in their own currency, but not impossible. It involves a haircut, forcing creditors to accept a reduction in principal or a forced conversion into new, less valuable instruments. For a 100-year bond, this would be a terminal event, shattering faith in the entire asset class for generations. The hidden interest rate for every other similar issuer would instantly skyrocket, as the premium for perpetual risk is repriced from theoretical to actual. The breaking point for the modern system will likely be triggered by a loss of the exorbitant privilege, the ability of the core issuer, like the US, to fund itself in its own currency at low rates because everyone else needs its debt. The moment a credible alternative emerges, a digital currency block, a commodity-backed system, or a coalition of other powers, the demand for the old perpetual debt could shrink precipitously. This wouldn't mean the U.S. defaults. It would mean it is forced to pay much higher interest rates to roll over its mountain of debt. The hidden rate becomes exorbitant in the other sense, triggering a fiscal crisis that forces drastic austerity, inflation, or restructuring. We are already seeing stress tests. The periodic debt ceiling debacles in the U.S., while political theater highlight the mechanical vulnerability of the rollover machine. Sanctions that freeze a nation's foreign currency assets are a direct assault on the premise of sovereign debt safety. Each event is a tremor, reminding the market that perpetuity is a convention, not a law of physics. The system is now a complex tapestry of interlocking perpetual promises, sovereign, corporate, narrative, all depending on a stability that their very existence undermines. As we approach our final chapter, we must look beyond the breaking point to what, if anything, comes after. If the age of hidden interest rates and perpetual debt cannot last, what follows? The end of this financial era won't be an apocalypse, but a great unwinding and a painful rediscovery of time. The future of finance may look less like a bet on forever and more like a series of explicit, shorter-term contracts between consenting generations. One path is the rise of debt with built-in sunset clauses. Imagine a 100-year green bond that automatically converts to equity in the renewable project it funded after 50 years, or a sovereign bond whose principal amortizes is paid down over its last 25 years. These structures acknowledge finitude. They reject the fantasy of eternity and instead create a clear, manageable path to zero. The hidden interest rate disappears, replaced by a transparent schedule of obligations and transfers. Finance re-engages with the reality of time and decay. Another future lies in the radical decentralization of credit. Blockchain-based smart contracts could enable peer-to-peer lending with dynamic, algorithmically adjusted terms that respond to real-time data, making the notion of a fixed 100-year rate obsolete. Perpetuity could be broken into a rolling series of much shorter, constantly renegotiated agreements, distributing risk more efficiently but also introducing new forms of systemic volatility. The empire of the single, monolithic, century-long loan could fragment into a galaxy of micro-contracts. Most profoundly, we may see a cultural and political shift that repudiates intergenerational debt on ethical grounds. Legal or constitutional amendments could limit the duration of sovereign debt to, say, 30 years, the span of a single generation with political voice. This would force a brutal, immediate honesty onto fiscal policy. Spending would have to be matched by taxation or by debt that the current generation commits to repaying. It would be the ultimate abolition of the hidden interest rate, forcing the costs of empire and entitlement into the daylight of the present. But history suggests a different, more likely outcome, not abolition, but transformation. The human desire to borrow against the future is too strong. The temptation for rulers to spend now and let others pay later is too great. The 100-year loan will likely morph again, cloaking itself in new jargon, embedded in new technologies, selling new narratives. The hidden interest rates that fund modern empires will persist because they are not a financial bug, but a feature of power itself. They are the mechanism by which the present consumes the future. Our task is not to naively believe we can end this cycle, but to see it clearly. To drag the hidden interest rates from the shadowy footnotes of history and into the light of public understanding. For when we see the mechanism, the perpetual rollover, the intergenerational transfer, the narrative collateral, we can at least begin to ask the fundamental questions. Who benefits from this forever debt? Who bears its ultimate cost? And what kind of world are we building with money that never, ever sleeps? The empires of the 21st century are not just built on silicon and steel. They are cemented with promises that outlast stone. To know this is to understand the true, enduring currency of power. This has been the 100-year loan, the hidden interest rates that still fund modern empires. If this deep dive into the financial architecture of power changed your perspective, your engagement is what keeps this channel alive. Smash the like button. It's the single biggest factor in helping these documentaries reach a wider audience. Subscribe to Blood Money Files and hit the notification bell, because next week we dismantle the myth of the petrodollar and trace the secret history of how oil became a weapon. Until then, remember, the most powerful stories aren't about the money you see, but the interest you don't.